Why a life policy should not pay out to you or your spouse. Hi, I'm Jaco Grobelaar, the founder and managing director of Prosperity Enterprises. In this video, we are going to talk about strategic estate planning, about trusts and your life insurance, and why life policies should never pay out to you or your spouse, but rather be paid out to a family trust. When life policies are paid out to an individual, it means that an individual sits with a big asset, a lot of cash, again, on their name, and that is what we are trying to avoid. So how do you navigate life insurance in your estate planning? Life insurance is often taken out to create liquidity and to make cash available when a person dies. Many people don't want their spouse or family to sit with cash shortages when it comes to paying estate duties, executor fees, capital gains tax, and transfer fees. And they thus take out life insurance to cover those expenses at death. However, when you do your structuring right, your deceased estate actually becomes a very small estate. Because remember, in one of our previous videos, we spoke about why you need to have two trusts, the family trust and the holdings trust, and a property company, and then with your properties in your property company. With that structure, you can ensure that nothing sits in your personal name. And when nothing is on your personal name, your estate, in fact, becomes very small. So there's very few costs on death. The only time when there would be a lot of assets on your name is when you started the restructuring process too late in your life and it becomes too expensive to move your assets out of your name. So in most other instances, when you start young or early and you make sure that you move your personal assets to your family trust, you fund your property portfolio through your family trust to your holdings trust and into your property companies, then you can sit in a position where one day when you pass away, that there are very few costs that actually need to be paid when you pass away. And this means that the lump sum can be paid out to the family trust, and the family trust can then make distributions to the beneficiaries as is required. When you have a life policy or life cover, whether it's on yourself or on someone else, and that pays out to the family trust, the family trust can lend that money to your other entities, such as your property companies, via your holdings trust, of course. And then your bonds in those property companies can be settled or partially settled, so that there's good cash flow in your property portfolio when you are not there anymore. So it's not to say that you definitely have to settle all of your bonds. Although that is ideal, sometimes that becomes too expensive. You then at least want to partly settle your bonds in your property company by money that comes from your family trust, life cover that was paid out to your family trust, so that you can improve your cash flow and so that you can have smaller bonds outstanding on your properties. Here are the benefits to a trust-owned life policy. Number one, no executor fees. When a life policy pays out to a trust, it will not form part of a deceased estate, and thus there will be no executor fees. Then it can create liquidity towards your property portfolio, since, as we said, your family trust can lend money to your property entities and cover the costs that are in your property entities. We also create greater continuity because this money that is now paid out can be kept in the family trust for generations and can affect generations to come. Those funds that are paid out to your family trust are also better protected, because when funds are paid out to an individual and something happens to that individual financially, creditors can come after all the assets, including that cash that has been paid out to the individual. Whereas if these monies have been paid out to the family trust and the family trust holds those assets or holds that cash, that money is also protected from creditors. And then lastly, over and above all, there are ample of tax benefits. So let your family trust be the payer and the beneficiary of your life policy. Your family trust can and should be the beneficiary of your life policy. Remember that payouts of a life policy is seen as a deemed asset in a deceased estate, which means that estate duty will have to be paid and that provision needs to be made for the estate duty that has to be paid on a life policy. This is irrespective of whether the policy pays to an individual or to a family trust. When it pays out to a spouse, however, estate duty will not be applicable. But remember, when the spouse passes away, the spouse will pay estate duty on all of his or her assets that end up in the deceased estate. And it is thus better to rather in the beginning have those monies paid out to the family trust. Having a family trust be the beneficiary and the payer of life policies also has a unique advantage. All premiums plus a compounded 6% of all of those premiums can be deducted off the amount that pays out when estate duty gets calculated. This is a massive tax saving. It is important to remember that you can't move big amounts from an individual to a trust without it triggering donations tax or Section 7C interest, deemed donations. So you don't want a lot of money to pay over to an individual and then an individual needs to struggle to get those assets back into the trust. So it's much better for your family trust to be the receiver or the beneficiary of a life policy. Let us at Prosperity Enterprises help you with your structure and with strategic estate planning. Remember to book your one-on-one consultation with us. If you like this content and would like to receive more of it, remember to like, share, and subscribe. Thank you very much.